Good afternoon, ladies and gentlemen. Welcome back to the third weekly market review of 2024. We are 2 weeks into the year already. And today I have with me, as usual, Mr. Gerald Wong, who will be helping us decipher what's happening in the market. How are you, Gerald?
Very good. I think now that we are into the third week of the year, slowly getting back into the swing of things,
Hmm.
and things are picking up a bit. We saw more economic releases in the market, and also we are entering the earnings season, so things are definitely picking up.
Yes, so last week we saw the CPI data, which comes in a little bit hotter than expected, but then the US market doesn't seem to be affected by it, but there's a bit of a pullback on the Singapore STI market, which we will touch on much in detail later on. And this week we are looking at the retail sales numbers as well as the continuation of the earnings seasons with some of the other major banks. But so far, not the earnings season have not provided any catalyst for the markets yet. But the outlook that the banks are projecting is still a positive year looking ahead. So I'm still confident that the market is still going to stay positive in the near future. But for now, let's let Mr. Gerald to break down what has happened in the past week and what are we looking ahead in the next few weeks.
Okay, thanks, Sunny. Okay, so the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. If you find the session helpful, do leave a review on Google. And we have a upcoming SIAS that's coming up this week. If you'd like to join the SIAS session to be able to ask us questions, you can join a SIAS member for $1 per month or $12 per year. Okay, so effectively what we saw last week would be a recovery in the market. S&P 500 up by 1.9%, led by gains in the tech stocks with Nasdaq up by 3.1%. And then the STI was also slightly up at 0.3%. So as we shared earlier, what we saw would be the inflation data that came out. The CPI was at 3.4%. So this is actually picking up from what we saw in November, where inflation was at 3.1%. Okay, so slightly above the market expectations, but still we saw that the market continued to rally with the increasing expectations that the Fed will still potentially lower the interest rates in the March meeting. Okay, so likewise, we see that being reflected in the trend of the US government bond yields. Earlier, we shared that the 10-year government bond yield had jumped back to above 4%. But even with the hotter than expected CPI data, what we actually saw would be a moderation in the bond yields, such that it's now back to below 4% once again. Okay, so effectively what we are seeing would be the rising hopes of a March rate cut. What we see here is that if I were to look at the expectations of the interest rate in March, okay, currently we are at 5.25 to 5.5%. Generally, investors are expecting that it'll be kept at this level in the January meeting on the 31st of January. But if I were to look at the March meeting, now the expectation is that it will be at 5 to 5.25%, which means one rate cut potentially in the March meeting. Then thereafter, we are seeing sequential rate cuts for each of the different meetings. So fairly aggressive expectations for rate cuts in 2024. If I were to look at this number for the March rate cut, say 1 week ago, effectively it would be close to 70% in terms of the probability of a March rate cut. And then when I checked it yesterday, it was at 77%. So there are rising hopes of a March rate which actually explain the bounce in the market that we saw over the past week. Okay, if I were to look at the Singapore market, we saw earlier that there was a slight bounce, but there were some stocks that performed particularly well. We saw sets with a gain of 7.7%. Thereafter, we've got Singtel with a gain of 2.6%, Yangzijiang Shipbuilding 2.6%, ST Engineering 2.6%, and last but not least, Sembcorp Industries with a 2.4% gain. So still very focused on the industrial names. We already spoke about Yangzijiang Shipbuilding last week and how it is seen as a beneficiary of some of the raising container shipping rates. And this week, what we'll share more about would be SIAS and Singtel. If I were to look at the worst performers for the last week, we have got Thai Bev, which was down by 0.9%, Keppel Corp 1.8%, Wilmar 2.3%, Hong Kong Land 2.9%, and DFR Retail Group down by 3.9%. What we see in terms of the similarities of these names is that they have exposure towards China, whether it's at Keppel Corp, Wilmar, Hong Kong Land, or DFR Retail Group. They are stocks on the STI with sizable exposure towards China. And given the weakness in the Chinese market, that has dampened sentiment towards this group of stocks as well. Okay, so I mentioned earlier that there were two stocks that did well on the STI last week. The first one is SETS. Effectively, what we see here would be a sizable bounce from 270 to actually close to 293 as of Friday's close. So what is driving the bounce in SETS share price? This was a chart that I shared last week, which is the container shipping rates. And we saw a very big bounce towards the end of December. Okay, what we see here is that the bounce has actually continued in the past week, such that it gained by 15% to be above $3,000 per 40 feet container in the last week. Okay, so the bounce in the container freight rates has continued, driven by what we are seeing in the Middle East. Okay, so likewise, if we were to break down the different routes, particularly if we were to look at some of these routes from Shanghai to Europe, it has effectively gained further in the past week. Okay, so as a recap, this was something that we discussed in the past week. Because of the incidents around the Red Sea, some of the shipping routes had to be diverted, and that has actually led to the increase in the freight rates. So last week we spoke about Yangzijiang Shipbuilding and how it has been seen as a potential beneficiary with the increase in container shipping rates. The other name that has also been having a bit of a bounce at the back of this Red Sea issue is actually SETS. Okay, so in case you are not aware of SETS business model, after the acquisition of WFS last year, cargo is now a sizable part of their business, representing about 49% of their revenue in the first half of fiscal year 24. Okay, so this effectively is a larger division now compared to what you might be familiar with, which is aviation food, ground services, which were the dominant part of its business in the past. Okay, so what we see here is that over the past few months, the cargo tonnage has seen some slight signs of recovery. Okay, it was weak with a declining trend between March and July of 2023. But by the time we got into August and September, it started and even saw a bit of a recovery in September 2023. Okay, so this is something that we'll continue to track in terms of whether it might potentially benefit from an increase in air cargo with the kind of bottlenecks as well as increase in freight rates that we are seeing for container shipping rates. Okay, so if you're to look at SETS, what we see here in terms of the first half FY24 results versus the first half FY23 results would be that the revenue grew. This is largely also driven by the acquisition of WFS. And what we see here is that while the revenue actually increased, the reported profit as well as the core profit actually is still loss-making. So what actually explained these losses in the first half of FY24? You still have the one-off integration expenses relating to the acquisition of WFS. So if we were to adjust some of these one-off items as well as other accounting issues, then the adjusted profit for SETS in the first half of FY24 would be at about 32 million. Okay, so this is something that we'll keep a lookout for in terms of how the increase in the container shipping rates will actually potentially divert demand into air cargo, and how SETS with the acquisition of WFS can potentially be a beneficiary of that. Okay, next we'll talk about Singtel, which also saw a bit of a bounce. Okay, now back to above $2.40 per share. Okay, so what I wanted to share today would be my takeaways from the SIAS Corporate Connect with Singtel last week. So this was something that we hosted with the management of Singtel, and they shared some of the recent developments and strategy of the company. So in terms of what the company perceives to be some of the key drivers, what they are seeing would be positive trends in the telco business, especially with the improvement in global travel. What the company sees would be a recovery in the roaming business. Okay, so for some of us who might have traveled overseas over the November and December holidays, that would definitely be something that we are looking at in terms of how we are using some of these data roaming services. There are two key businesses that Singtel has identified to be potential growth drivers as well, and they are riding on the digitalization wave that the company expects. So the first one would be NCS, which might be a familiar company that some of you might be familiar with, and then the other one would be its regional data centers. Okay, and then last but not least, in terms of the regional associates, including those in India, Thailand, and Indonesia, what we are seeing is that there has been consolidation in 3 of the 4 associate markets, which might potentially benefit Singtel as well. Okay, the other strategy that the company shared would be its capital recycling strategy. So if we were to look at the assets recycled in FY22 and FY23, that amounted to 5 billion Sing dollars. And then if we were to add what they recently announced, which is the proceeds from the sale of stake of the regional data center as well as com center, that would add another 2 billion. So in total, successfully recycled 7 billion of assets. At the same time, they have also sold some of the loss-making businesses, such as Amobi and Trustwave. So when some of these loss-making businesses are no longer consolidated, that might potentially provide a boost to the earnings as well. Lastly, what we see would be improvement in terms of the dividend payout. In FY23, total dividend per share of 14.9 cents, which is an increase from the 9.3 cents that was paid out in FY 2022. We have continued to see an increase in dividend payout in the first half of FY24 to 5.2 cents, and we await to see what the final dividend would be for FY24. Okay, so they have also revised their dividend policy to be now between 70 to 90% of the underlying net profit after tax, compared to previously when it was at 60 to 80%. Okay, so what we see here in terms of the dividend trend is that based on current market expectations, Singtel is expected to offer a dividend yield of about 4.6%. Okay, so with that, what we are looking out for in the week ahead, the US market will be closed today for the public holiday. But then once we come back tomorrow, we have a continuation of the US bank earnings with Goldman Sachs and Morgan Stanley reporting. We also have a major data point, which is the US retail sales data on Wednesday. And for those of you who are looking at the Singapore T-bill, we have the next 6-month Singapore T-bill auction coming up on the 18th of January on Thursday. Okay, so with that, I'll hand over to Sunny, who will share with us more about the latest technical indicators.
Okay. Hey, thanks, Gerald, for the insightful sharing on the biggest movers on the STI index last week. And now we are looking at the STI chart. So what has happened to the STI in the first few weeks of this year in January? So of course, the first week we saw a very big pullback, about 3%. Last week we are sort of up about 1 point something percent. Let me double check the numbers for you to the 1.73%, if I remember correctly. If I look on the weekly, correct, 0.23%. So we are at 0.23% last week. So we more or less arrested the fall in the first week of January. So during that time, I said that this was the support zone that we are looking at, where we expect demand to come in. And this zone is actually referencing the June low of last year, which is around the low over here, this June period. So this theory or this thesis proved to be true so far, and we have touched a low of about 3159 around the 4th of January and the 10th of January period. So the question I have in my mind now is it time to get in yet? So if I get in around here, my first target, of course, would be the December high at 3250. And this looks to be not of a very lucrative margin that we are looking at. If I'm looking at what kind of trend STI could be carrying on going forward, if I connect the low of December last year, the 2 points over here, and then I have a trajectory upwards, this can become an uptrend support line. And at this current level of about 3199, 3200 points level, it still can pull back a little bit before I can get in on a safer margin to ride the trend upwards. So what do I see in the STI index? I still hold on to this support zone that I have indicated here. And if let's say we does pull back to the 100 days moving average, which is the amber line, this indicator over here, 3160, or even the blue color line, the 50 days moving average, the 3152 level, that would be my entry point for the STI index for a short-term long position to target the 3,250 points level. Okay, so this will be the first trade on the STI that I'm eyeing so far, but so far it has not triggered my buy order yet, or buy limit order. On the indicator side, as you can see, the MACD indicator starts to converge towards the signal line already. And just today, we don't have the close for today yet, but we are seeing a negative MACD reading already. That means that the upside momentum that we see over here in December period has already been negated, and now it's pretty neutral. And once the divergence of the MACD line towards downwards away from the signal lines, that could signal further downside to come. That's why I am not so comfortable entering the STI market at this moment, but would rather have a bit of safety buffer and wait for a pullback before I start considering entering the STI market. On the RSI, the reading now is at 59, so it's a healthy reading. It came back down from a high of about, let me see, 75 points in the peak of December. So now we are below the 14 days RSI moving average at 62. This also signals that the momentum that we observed previously in December has been subsiding already, but there is still positive momentum and it is still above the 50-point neutral mark. So that is why STI could range in a range-bound direction using this zone as a support level. So we do still need to wait for some movement to come in on the STI before it gets in on a firmer support level to get in and then starts to trend on the uptrend that we see over here, connecting the lows in December. Okay, so that's my take on the STI. Let's move to the major US indices right now. Every time these few weeks or these few days I look at the US indices, I'm a bit speechless because we are at an all-time high. It's very difficult to get any reference zone in the previous few years. So where is Dow Jones likely going to hit going forward? Of course, this red candle over here last Friday was the effects of the CPI numbers, which came in a bit higher. So market have a bit of a pullback, but it's just a very minor one. It has not went back to any retracement for a key support level. Now, the first key support level that we are looking at here will be this blue color line, 36,592 points. Okay. And this was the high, I believe, is 2 or 3 years back. that was at the beginning of 2022 or the end of 2021 period. So that was the previous high that we saw. And then that would be the first support for the Dow Jones Index. But even at that level, I would still believe that it's a bit elevated. It's close to the 20 days EMA, 20 days exponential moving average, and that is the short-term moving average, which usually follows the trend of the uptrend. So I would rather wait for a pullback to at least the 50 days moving average. But then you could argue that does that mean that we would miss the rally that is happening right now? I think with a bit of hindsight and experience, there would always be a situation where there will be a pullback, whether it's geopolitical risk, the Red Sea situation, Taiwan elections. So I would rather be patient than get in on a very elevated level and then things I do not have a safety buffer over here. So if that does not happen, that means a lot of fund managers, a lot of traders, even like myself, will be challenged to not buy the broad-based index anymore. We might have to work harder to go into stock picking and look at which are the stocks that will outperform the index. So this is my take on the Dow Jones Index. Similarly, the indicators are now in the negative zone already. MACD indicator trending downwards, and looks like a bit of divergence between the MACD and the signal line, and they are both going towards the zero baseline. The RSI has come down from a high reading of about 85 points, and now we are at a 64 point level. We are also below the 14 days RSI moving average. That means that we are in a downtrend. And so this we expect some pullback for the Dow Jones Index. At least the first support, as I said, will be the 36,950 points level. After that, the 50 points moving average would ring some alarm bells and get my heads up to see where the Dow Jones Index is heading, and could there be opportunities arising if we have a pullback towards the 50 days moving average at 36,384 points. Next, let's move to the S&P 500. So the S&P 500, we do have a little bit of a pullback at the early part of January, but now we are back to the all-time high again. So we are looking at it hitting the resistance level now at 4,818 points level, which was the high we observed the same thing back in the early part of 2022. Okay, so this you could see as a double top. You could see as a previous resistance level, definitely at a very elevated level, which is not safe or comfortable for traders to go in on a long position at this point from a technical perspective. So I believe the technical traders are waiting for a pullback. So same thing, the S&P index point is trending along the 20 days moving average, which is also the basis of the Bollinger Band. But then the next support, I believe, will be coming in. The 50 days moving average, 4,624 points, would be the area that we are looking at. And it also now found confluence with the high in July last year, and which may have a change in polarity from a resistance to a support level, giving some support to the S&P 500 should a pullback happen. So similar to the Dow Jones Index, the MACD indicator is now in the negative territory, but the negative momentum seems to be subsiding for the past 4 or 5 sessions on the S&P 500. So it's a negative momentum, but the momentum is subsiding right now. So don't expect a big aggressive pullback, but probably towards the 50 points EMA level is still a possibility. The RSI reading now at 65, a healthy range of reading, but it's coming down from the high of 80 points in December. So now, although it's a healthy reading, there is some positive momentum and not in the overbought territory of above the 70-point RSI level. But it's a downtrend, so if the uptrend is likely going to continue, we would want the RSI to stay above the 50-point neutral mark to maintain this positive momentum that they have. And then we will see whether the MACD will find some concurrence with a overlapping of the MACD above the signal line. Thereby, the two indicators would have agreed that the uptrend is likely to continue, and then that would be a much firmer indication that the S&P 500 can climb higher. Although I have a sense whether it can climb higher or not would also depend on the earnings seasons, whether the numbers and the projection coming out is likely going to support the valuation that we have so far. So these are some of the developments that we are looking out for. Next, on the Nasdaq Composite Index, which paints a very similar picture to the S&P 500. Same thing, we have a pullback towards end of December and early part of January. Now we are very close back up to the all-time high again, which is the high in December. So that just at the line there to mark where is that level. So 15,150, correct? That is the number. We are looking at crossing above the 15,000 handle for the Nasdaq Composite Index will be a key moment. But at this moment, for the uptrend to continue, I'm still looking at some trajectory over here, the uptrend possibility. So even with the from what I see over here, the longer term uptrend might be somewhere around the 50 days moving average, or even between the 50 days and the 100 days moving average. That will likely see some support coming in. So why this level? You can also see the previous high that we see in July as well as in September. Those resistance can also have a change in polarity to become a support level for the Nasdaq Composite Index, and then we may find demand coming in around this zone again, around the 14,500 point pivot level, I would say. So MACD indicator still negative. RSI coming down from the high that we have in December. So momentum is I would say neutral to negative, because MACD is negative. RSI is coming down, and I would say it's going towards the neutral mark. So I think a lot of upside has already been priced into the major US indices right now, and we are into the earnings seasons to see whether this pricing in of the valuations is sustainable with the results that are coming out. Okay, so that's all I have for this week's technical updates. Anything to add on, Gerald?
Yeah, I think like you said, what we are looking at closely now is the result season. Given the rally that we have seen already in the US market, the US companies really need to deliver in terms of their results, and we'll continue to provide an update in terms of how they actually fare versus the market expectations.
Yes, and recently we also have the launch of the Bitcoin ETF. So as a technical person, I think maybe it's also time to add on the technical charts of Bitcoin to our weekly market review. I will think about it. I need to study it again. Have not touched on Bitcoin for quite some time, but definitely Bitcoin now is as a derivative with an ETF options open up a lot of doors for investors to consider it as asset class. But definitely it's not for everyone. Okay, and on Wednesday, we have our SIAS session, right, Gerald?
That's right.
Yes.
So if you got any questions around what we shared today, the fundamental analysis, the macro, or the technical analysis, join the SIAS, and we'll be taking your questions there.
Okay, and I think that's all the time that we have for this weekly market review. So we do appreciate your support. Do give us a 5-star review on Google, shamelessly asking over here again. And we will see you again next week in the next weekly market review.
Thank you.